All right, ladies and gentlemen, I hope you had a wonderful weekend and happy Memorial Day. Don't ever forget what this holiday is really about. I know we got a day off, but for real, with all of the history lessons, we going over what happened with economies and how it led to this, man. Things would be a lot different without the sacrifice that many of our heroes have made. So we say it every day, but we'll double down on it once again, man. Shout out to the veterans, the families, and everybody who has served this country. Whether you are a pacifist or not, we have been able to enjoy the fruits. So for real, man, shout out to the vets. You know we love you guys, and keep that up, all right? But now we still got a big week ahead of us. Last week we came off of the NVDA and the earnings and low liquidity and getting ready for the holiday. So now we do only have 4 trading days, but we actually got a little bit in store, and this is the final runway leading us into the second half of the year, baby. So we got a lot to talk about. I have the plays, I have the keys, all the good stuff, the questions, even an economic lesson. What I need from you, a thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. And before anything, don't forget, today is Sunday, tomorrow is, today's Monday, tomorrow is Tuesday. Wow, this is the day for the random account. What we need from you guys, post a random option trade in the comments below. Keep it below $100, and tomorrow morning, we're going to do a random account generator, a comment generator, and see what we get. But I don't know, man. Here's the chart. It was doing decent, and then I didn't show you the chart, then it went down, then I showed you it, then it went up, and then now, yeah, so we need your help, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, before we get into the keys, we will come back to this chart a little bit here today, but what I want you to understand is what we are coming off of. Remember, it was NVIDIA earnings last week, and they did good. They blew it out of the water, but you got that weird effect, the rotation, sell everything but NVIDIA. We also had to deal with commodities. They were hitting those highs, then they came down, and then everybody was kind of scratching their head. Not to mention, you had all of those Fed speakers and the bonds still not doing too well. So it was a very interesting week last week. It is now leading us into this week, and even though we only have 4 days, we actually got a decent calendar. So before I talk about that, what I want you to understand, the title of the video and where we're moving. Do you not realize that by the end of this week, it will be the end of May? Once we start getting into June, not only do we have a big SEP from the Fed, not only are we going to get all of that economic data, but now this is the second half. There is both seasonality, cyclical, and not cynicism, but cyclicalism. I don't know how to describe it there, but the point is, second half, this is where people are looking for things to get proven from the first half, for plans to go forward if you didn't do good, or maybe you have a better performing quarter at the second half. This is where things are going to show up. But what I'm trying to tell you is that the thinking for these next couple of months now till the end of the year, it's going to be different than starting off. Now we are going to be looking for the conclusion of certain things, whether it's the AI, the earnings, but especially the Fed. The point is now you got to start thinking a little different here, or at the very least, you may start seeing the market move different, whether it's good news, bad news, or anything of that nature. But get ready for it. We are now about to be in the second half. That is your first key, and now coming into the second key, what we're going to be dealing with this week, we have a ton of Fed speakers. So even though there's only 4 days, I think you're going to hear from at least like 8 to 10 Fed speakers lately. They have been all a little bit more hawkish. The market would respond here and there. We are going to get a little bit more data. I believe tomorrow you got the S&P manufacturing PMIs. You'll get real estate data, Conference Board of Consumer Confidence. We're going to get the GDP on Thursday, and then Friday, that will be your finale in terms of data, because that will be the biggest one, the Fed's favorite inflation gauge. But the thing about this week, whether it's Fed speakers or some of these smaller data sets, last week showed us some pretty big reactions. Even like Thursday, Friday, I believe it was one of the other PMIs, we had a big reaction on the bonds, and then eventually that was the day of NVIDIA where only NVIDIA held up, and then we actually had a big down day. So the data, if the liquidity is going to be low, if volume is going to be low, it may not be our most important data, but I wouldn't be surprised to get some bigger moves. So I'm going to be keeping my eyes out for that. You should too. Otherwise, Fed speakers and PCE, that is the short way to sum up this week. But coming into the final key, I already gave you guys a little bit of the history here, or I guess history was only a week, but don't forget what is going on. The bond yields are still high. We are hugging that 4.5. People are still debating rate cuts or not, whether it's data, Fed speakers. We're getting a couple of small moves, but this is still one of the bigger factors. The other one is central banks. We are going to hear from Canada and a couple of others, but remember last week, even the British pound was moving, and there was a lot of global currency moves, and depending on what these central banks do, it could affect everything from bond yields down to commodities and then gold especially. But these are the X factors. Don't forget about that. But now the final thing, I told you we come back to the chart here. This SPY is moving much more different than it did last time we started breaking out. And what I want you to realize, we're doing kind of what we had here in April. It's not as up tilted leading in from the beginning of March, but point is, yeah, we had that volatility, we broke out, but we are kind of doing this pin at the high. We were talking about it last week. You're not getting these 100 points at a time rips, and the fact is, if we do start to stall out here, keep in mind, whether it's second half, the data, or maybe we just got to get that SEP here in a couple of weeks. The point is, we are doing good. We are at all-time highs, but it is not the same mania that you were dealing with at the beginning of the year, especially given that you have just heard NVIDIA and AI is still killing it and taking over everything. So don't forget about all of that. I would definitely watch the price action at these levels. Maybe you'll get a Pump It Up or a Timmy Turner, but the point is, it is different than what got us here. But all in all, second half, broader themes, keep it in mind. Watch out for the Fed speakers in the PCE, and then we'll see if any other central banks, bond yields, or commodities will give us something else to react to. But now, let us get into the plays. So, right off the bat, I have a couple of different plays. I think even the first one, it might be weird. Ozempic. Yeah, so I'm not telling you to go buy Ozempic, but I would watch out for any of the Ozempic-related plays. Eli Lilly, NVO, Amgen, we heard about a couple of weeks ago. The small ones, VKTX, all the way down to Vanny. But even Friday, I think it was like FSR, Fresenius Medical, and a couple of others. We heard a lot of updates. You probably even heard about the South Park episode as well. Point is, I'm hearing a lot of Ozempic updates. Last Friday, we got a little bit more of those movers, so I would watch out to see if this keeps continuing, and maybe it will be an outperformer. Maybe the whole market doesn't want to go gangbusters, but if we do get individual news, if we see this industry expand and we start getting more big news, this might be its own little driver. And even the cherry on top, just keep an eye out on healthcare. It's been doing good, but it's also still one of those values this year. So that is play number one. Watch out for that. Then play number two, I hope this one's obvious, but NVIDIA, ARM, Qualcomm, SMCI, throw in your favorite, Intel, AMD, it doesn't matter, but we do got a little bit slower of a week since it's going to be Tuesday tomorrow, but let's see if these AI plays get some run here, because again, Friday was very calm, and Thursday as well after a blowout earnings. We did watch a couple of these chip names come up, so I want to see, is this going to dominate the theme still? They're coming off of good news. We're leading into the second half, or are we going to get a little bit more hesitant given the reactions, all the new bars being set, and then finally, you got Powell right around the corner, so don't forget about that. But I'm going to be watching those plays. I'm still getting clapped by my Intel, so that's all I got. But I did sell out of my NVIDIA. We lost on that Iron Condor. We made like $500 on the shares. Lost 280 on the Iron Condor, but no plays now, and we'll see where anything else leads us. But that is play number two, and then finally, play number three, baby, gold. So this has been a play we've been in on the micro futures, but hopefully you saw it last week, dude. The range is absolutely ridiculous. And this is the main point here I'm saying with the play. It was looking good over the holiday. If you guys weren't familiar, futures were open yesterday. We had futures trading on the SPY, gold, everything else. And even for gold, it got a nice bid here. Some people were waiting for this week, get over some of the holidays and some of the China stuff. But fact of the matter is, it's looking good now with how we've positioned, but it doesn't matter because that could be here today, gone tomorrow. And what I'm telling you, it's all about this range. You're getting $100, $150 on gold every other week, man. These can be some big movers. You got to be careful, but that's why we have had so many talks on positioning. So I'm going to be watching this. Maybe we'll make a couple of plays on this. We're going to be riding one out. I can take profits, go back in, and play it according to whatever we get, central banks, data, all of that good stuff. So those are the main plays. As far as everything else, I did make a couple of plays on Friday. Like I told you, we lost on the NVIDIA. That one just expired. I forgot to give the explanation on the other watch list, so maybe we could talk about that one at another one if you're interested, or we'll just do another play. But I did sell out of Gill on Friday. This is that buyout play I've been holding. I think I gave you guys an update on it about 30 days ago. And remember, I was telling you they're waiting for the board and there was all of this drama. Well, the current CEO left and they let the activists take over the board. Stock popped off of it. I was up, but I was just getting tired of holding. I really think it has more upside, but unfortunately, I needed liquidity, okay? I don't know what you think or some of you think. I don't know what it is, but I do need some money here and there, and that's where, and I think this is a good lesson. I don't know if it's both leverage or balancing out because I didn't use leverage on this as much. I've had a lot of cash, but the thing is, I've had other plays now. I went big on Baidu and Intel, and I put a lot of cash towards that. And then I had these plays go down. Baidu would fluctuate like green and not. Intel, I just got murdered. But I had another decent-sized play on Gill, and I want to wait for it. But this is just word to other plays affecting the other one. So when you leverage, you go on margin. And I'm not saying that's what happened here because I did allocate my cash towards it. I did use a little bit of margin, and it's not like I'm getting totally clapped, but I'm thinking ahead. And that's why I was saying, well, I got a profit on it and I'll take it. But this is a good lesson of how outside factors can affect how you hold other things. And this is where people make errors in the market because if you do keep it small, focus on a couple of plays, balance it correctly, not going too big or anything, and you are able to hold it and ride it out, time will be on your side, especially if it's equities. But if you now have other plays, you go big on some others and they start to hurt, then you're going to think. So in my case, I was thinking, well, if I'm down on these two, if Gill did turn on me again, I don't think I would like that. I didn't want to be in that position. So I said, hey, let me trim a little bit, take a small profit, and then move from there. But hopefully me sharing you all of this is something you can learn from. But that was the first play I made on Friday. And then I got out of my MNQ. We made a couple of nice moves on that. Remember, this is my second one. I played the other one, got out of that for like $600. We did the two. I was down on them after the NVIDIA day. Then it bounced back up. Got out with 560 and then chilling. But that was everything. No other plays. If you do have any, post them in the comments. But now for the questions. I only got one because we got a big lesson here today. And this is a great question. They said, Josh, actually they didn't say that, but best long-term stocks for beginner investors. Now, I feel like I've answered this question. I feel like I've gone over it, but especially now we're about to get another deposit. And in the long term, I did not use it last week. So I'm going to be stacking up some cash here. There's a lot of different plays, but to answer this question, it is very simple. You are just starting your long term and you want to make it. You should go watch the video. It's in the description there of the live stream. And I sound prepubescent in that video, but oh my goodness, even young Josh knew, bro. You know what I'm saying? For real, the strategy is all the same. And you need to go for names that you know about. You've never made a portfolio. You should start with the stuff that you use every day in your life. There will be a time and place where you will get to go and bet on the next big thing where you're going to be like, oh, I think this is going to do this Ozempic, this flying EV car that cured cancer, whatever it may be. I was trying to think, but the point is you'll have a time and place for that. But the whole idea of the long term is that if you could start setting up a good base now, get your balance in play, it will preserve your capital no matter what happens in the market. The idea is to always be having value and being able to also benefit when the market makes moves. So I would start out with the names that you know. Ideally, you're going to want the names you know about, that you have known about in the past, and that you can reasonably expect they will be around in the future given how they perform and their impact on society, culture, and just overall necessity to everyday life. The hard part about this, though, is that the good names, a lot of them are expensive. One of them this year was like the beginning of the year, and I've had this conversation a lot, and I was telling people, focus on quality names, focus on the stuff that you actually like and that you use. And one of them was Procter & Gamble, and it wasn't trading at a premium. This one is already up. And the problem you're going to see is that a lot of the names that meet this criteria, they're probably trading near all-time highs. And that's something that I've been doing for almost 2 years now, is what I've been saying, is that I am not going after these names at all-time highs. I'm going for the names I know about, have been around. I know they'll stay around and have that good blue chip qualities, but they're simply just trading at a couple year lows, maybe some even a decade lows. I'm looking at you, Pfizer, but the point is some of these names that are high quality, they will be at a premium, but that doesn't mean there isn't these great names that are trading lower. Now, here's the deal. Even if you don't want to go for some of the value plays and you like some of the stuff at all-time highs, that's okay. You just have to balance it out, and you're going to have to do that by actively averaging down, staying consistent with the play, and above all else, though, this is what I always say, is just let your portfolio speak to you. Depending on what you have in the portfolio, it'll say, yeah, I need some of that growth. I need some of that quality. Or if there's other areas lacking and you could get a discount, you could put your money there until some of these come back. So that being said, it's more than just picking a stock, and I hope you guys realize that. Maybe, too, don't underestimate the power of an ETF as well, but the point is it goes beyond just an individual name. So I'm going to share some with you that I like, but everything I just said, if you really want to be effective and grow a bulletproof long-term portfolio, you got to think of it beyond just what the company and name is, and it's factoring into the whole portfolio, looking at value, getting strength of your dollar, and then balancing it out over the years. And that's where any move today is pretty meaningless, because you will balance it over the next decade. But that being said, here are some of those names that I think are high quality. They've been around. A lot of these names are struggling in the short term, and that's why they're all trading at discounts. But in a world where everyone's like, oh, why would I buy in all-time highs? I'm like, all of these names you know about. They've been around. They will continue to be around, and they're trading at multi-year lows. Nike is one of them. Starbucks, Intel, Bristol Myers, Pfizer. I just went up on Pfizer, but it's still cheap. And then UPS and Whirlpool. These names are integral to American life here, and you all know about them. And that's why I'm like, these could be good ones, and if anything, these are the names I'm looking to use my next deposits. I would like to stack up on my portfolio, but these names are definitely calling out. So that being said, I hope that helps, but I only have one question today because we have a big lesson. So yeah, we're continuing along. We've been talking about the World Trade Organization and these trade agreements, and we are going to wrap that up. We're going to talk about regional trade agreements. Some of you brought up some questions on the other lesson, and now this is what it's going to answer those questions. I'm sure you guys are going to learn a lot. And the best part about this is I hope that this gets you familiar with some of the trade deals that all of you have heard about. And this is stuff that goes on the daily. Like I said, one thing you could take out of all of these lessons is that it may just improve your vocabulary with some of the concepts that come up on a trading day. When we're going through 7 hours, we're hearing stuff all over. I'm sure this is giving some color to all of that. So that's what we're going to talk about. It is going to lead us now, after we conclude this chapter, we will be able to now start touching on more of the complex understandings of how international competition affects policies and economy. So let's get into it. But before, I really hope you guys check it out. If you go to this channel, there is a playlist starting with the first video leading into this now. And why I want you to watch those is so that you could, one, be up to speed with this, because now we are just moving along. But two, when I do go over this, I really hope you guys learn. And with that being said, my job and what I like watching here, this is why I use this book, it goes over both sides very fairly. There is really not that much bias. If there is, we could call it out. But I want you to understand the idea here is to understand every side, understand the history so that you can use this as a tool and, again, sharpen your craft. But the point is, anytime I interrupt, it is all my opinion. So you got to find a way to differentiate. I'm going to let you know. And my opinion, I don't want it to bias you, but I will tell you when it is opinion, and you do need to be aware of that. So that being said, baby, let's get into it. What do we got? The greatest challenge, ? Regional trade agreements and the World Trade Organization. Regionalism is one alternative that has gained particular appeal. Indeed, many observers believe that RTAs, regional trade agreements, pose the single greatest challenge to the multilateral trade system. RTAs pose a challenge to the WTO because they offer an alternative and more discriminatory way to organize world trade. An RTA is a trade agreement between two or more countries, usually located in the same region of the world, in which each country offers preferential market access to the other. RTAs came in two basic forms: free trade areas and customs unions. In free trade area like the North America Free Trade Agreement, governments eliminate tariffs on other member goods, but each member retains independent tariffs on goods entering their market from non-members. In a customs union like the EU, member governments eliminate all tariffs on trade between customs union members and impose a common tariff on goods entering the union from non-members. Because RTAs provide tariff-free market access to some countries but not to others, they are inherently discriminatory, though such discrimination is inconsistent with the GATT's core principle. GATT Article 24 allows countries to form RTAs as long as the level of protection imposed against non-members is no higher than the level of protection applied by the countries prior to forming the agreement. Nevertheless, the discriminatory aspect of RTAs makes many worry about the impact that they will have on non-discriminatory trade encouraged by the WTO. So if you're not getting that, and again, from the past lessons, we've been talking about how the WTO and making these trade agreements, well, this is kind of the workaround, these regional trade agreements. But what they're saying is like, okay, yeah, it's allowed, but as long as you're not making these agreements and then raising the penalty. I guess what that would be is like it'd be like if I made a trade agreement and I said, okay, I'm not going to charge the members for the stream alerts, but then right after I do that, I quadruple the price of it. And I don't know if that's a perfect example, but hopefully you understand the general concept, workaround, loophole, etc., etc. But continuing. Such worries arise because of the rapid proliferation of RTAs. According to the WTO, there are currently 270 RTAs in operation. If all RTAs now planned are created, there may be as many as 445 RTAs in effect. Free trade agreements constitute the vast majority of these RTAs for 86% of existing RTAs and for 99% of arrangements currently being negotiated. More than half of all RTAs are bilateral agreements. The others are plurilateral agreements that include at least 3 countries. RTAs are densely concentrated in Europe and in the Mediterranean region. Agreements between countries in Western, Eastern, and Central Europe and in the Mediterranean account for almost 50% of the RTAs in operation. North and South America take second place, accounting for about 12%, until quite recently Sub-Saharan Africa and Asian Pacific states. So I'm going to interject opinion, but I want you to, here's a pop quiz. What would be a potential effect? What potential industry would be affected if we're saying here that 86% of these are European, but then also the Mediterranean? There is a higher degree of those trade agreements or RTAs. Why? Or what industry could that affect? Pop quiz. You let me know. RTAs have emerged in 3 different waves, or distinct waves. The first wave began in the early 1950s and extended into the mid-1970s. The wave began with the construction of the original European Economic Community in 1958 and the Latin American Free Trade Agreement in 1960, and concluded with the formation of the Economic Community of West African States in 1975. This wave was motivated in part by a desire to promote deeper economic cooperation within particular regions in an attempt to promote peace and achieve more rapid economic development. In this regard, the contribution of the EEC, the Franco-German political reconciliation after World War II, and the rapid post-war economic recovery encouraged by governments in other regions to emulate the approach. This early enthusiasm waned, however, as the economic gains realized in Europe did not materialize in the so-called developing world imitators. The second wave began in the next context of far-reaching trade policy reforms in Eastern and Central Europe, the former Soviet Union, and other developing countries. Governments and former members of the Soviet bloc, for instance, sought new ways to organize their trade and sought access to Western European markets. Consequently, a large number of agreements were reached between countries within the region and between these countries and the EU. Moldova, for example, entered RTAs with 8 other newly independent countries formed from the former Soviet Union between 1992 and 1996. Russia entered at least 9 RTAs with the same set of countries. 10 Eastern and Central European countries reached bilateral RTAs with the EU between 1991 and 1997. There were also substantial changes in the developing country trade policies in the late 1980s and early 1990s, which led to a greater willingness to enter RTAs. Mexico, for example, negotiated RTAs not only with the United States and Canada, NAFTA, but also with Chile, Costa Rica, and Nicaragua. Chile negotiated RTAs with Colombia, Ecuador, and Peru, in addition to completing the agreement it reached with Mexico. The third wave began in 2008 or so of this closely associated with the so-called mega-regional agreements. The two most prominent of these mega-regional agreements are the Trans-Pacific Partnership, TPP, negotiated between the U.S. and EU, and the Transatlantic Trade Investment Partnership, TTIP, which was negotiated by 13 states in Asia and North and South America. A third mega-regional, the Regional Comprehensive Economic Partnership, ties China to 15 other economies throughout Asia and the Pacific. In contrast to previous waves, which tended to focus more heavily on trade liberalization, the mega-regional agreements seek deeper economic integration amongst their members. To achieve this goal, these agreements are both broader in scope and reach more deeply into domestic arrangements than prior agreements. The TTIP and TPP were intended to promote cooperation and harmonization on technical barriers to trade, which are domestic rules, regulations, and administrative procedures that could limit trade flows. In addition, these agreements included trade and services, more ambitious rules regarding the protection of IP than are present in the WTO, and agreement on the treatment and protection of foreign investment. The TPP included most of these issues, as well as an elaborate and enforceable code on labor standards. So hopefully the history doesn't bore you out, but what you need to understand is the waves. Literally, there's one wave that went through again. That was 60s, and then you had the second one that expanded into more countries, and then now, modern times, we are getting our other wave. Why I want you to pay attention to that? Because this is how everything works. How we got to where we are with economics, how we got to certain policies, government structures, how they lead, it's usually in these waves. That's why the interesting part about us being alive right now and what we're seeing in the economy and everything else, it should be asking you, what wave are we in? Or is the other wave ending, and are we leading into something new? They're bringing the AI. So yeah, hopefully you get it. But moving on. Why have RTAs proliferated, especially since the 1990s? Scholars have advanced a number of general explanations for this trend. Some emphasis a country's desire to gain more secure access to the market of a particularly important trading partner. In the U.S.-Canada Free Trade Agreement, concluded in the late 1980s, for example, Canada sought secure access to the U.S. market, the most important destination for Canada's exports. During much of the 1980s, the United States made frequent use of anti-dumping and countervailing duty investigations to protect American producers from Canadian imports. Such measures clearly interfered with the ability of the Canadian producers to export to the American market. The Canadian government hoped that the U.S.-Canada Free Trade Agreement would give Canada some degree of exemption from these measures. Other scholars emphasize that governments need to signal a strong commitment to economic reform. Governments use RTAs to convince foreign partners that they will maintain open markets and the investor-friendly policies. This argument has been applied most commonly to Mexico's decision to seek a free trade agreement with the United States. Mexico shifted from a highly protectionist to a more liberal trade policy in the mid-1980s. The success of that strategy hinged in part on Mexico's ability to attract foreign investment from the United States. The Mexican government feared, however, that American investors would not believe that the Mexican government was was committed to its new strategy. What would prevent Mexico from shifting back to protectionism and nationalized foreign investments? If American businesses didn't believe the Mexican government was committed to this liberal strategy, they would be reluctant to invest in Mexico. Absent American investment, Mexico could be deprived of foreign capital that was critical to the success of its strategy. So hopefully you see where we're going now. Explain the history, explain the ways, but this is why I've always appreciated this book. It's explaining both sides. It's saying, yeah, there was an economic reason, or again, people debate. There could be economic reasoning where it's saying, well, yeah, they want access to this market because literally market economics shows that they need it. The tariffs and things are hurting them, but other people are saying it could be symbolic to attract in other investments and be like a sign. And again, doing it more for political reasons and other reasons purely than just benefiting off of economics, lower tariffs, all of that good stuff. So fascinating. A free trade agreement with the United States allowed Mexico to signal to American investors the depth of their commitment to the market liberalization. It did so in part because NAFTA contained very clear and enforceable rules concerning the treatment of foreign investment located in Mexico. A similar agreement might be used to understand at least part of the interest that European and Central European governments had in signing free trade agreements with the EU. These governments were also reorienting their economic policies and were trying to attract foreign investment. Like Mexico, they might have needed an external institution, such as agreement with the EU, to signal to foreign investors their commitment to market reforms. Notice that these arguments actually place less emphasis on the trade benefits that might result from RTA and focus more on the need to attract foreign investment. So it's not about all the trade. They want to join the club. Other scholars argue that countries enter RTAs to increase their bargaining power in multilateral trade negotiations. A small country bargaining individually in the WTO lacks power because it does not have a large market to offer. By pooling a group of small countries, the market can be offered to trade partners in WTO negotiations, increases substantially. Consequently, each member might gain larger tariff concessions in WTO negotiations. Current American enthusiasm for RTAs may also be seen as an attempt to gain bargaining power in the WTO. As it has become more difficult to reach decisions within the WTO, the U.S. has explicitly threatened to rely more on free trade agreements. By doing so, the United States denies its market to countries unwilling to make concessions in the WTO. The fear of losing access to the U.S. market could induce governments to make concessions in the WTO that they would not otherwise make. The threat to rely more on RTAs and less on the WTO enhances the American power in organization. So hopefully you see where that one's saying school of fish, where, yeah, maybe there's other economic offense. They want to join the club, but these small countries, if they're like, yo, let's make our alliance of trade here, and now we come to the negotiating table, we could offer a lot more and get a little bit more bargaining power. And then on the reverse, the United States, they the one on steroids, bull in China shop. Pretty much the RTA could, or the USA can dangle, and this is my opinion, but this is what it's explaining. They could just dangle these things in front of all the other countries and say, listen, if you're not going to agree on WTO stuff, China, then we're just going to make a bunch of regional trade agreements, and then that way we don't have to worry about you. So very fascinating once again. Continuing. Finally, and clearly relevant to the emergence of mega-regional agreements, the impasse of the Doha round encouraged states to find other paths along which to pursue their trade policy goals. These agreements have enabled the EU, US, Canada, Mexico, and South American countries with Pacific ties, as well as a few partners in Asia, to pursue economic integration on issues of common interest and concern that they could not address in the WTO. Given the resistance by many members to the initiation of negotiations on new issues, digital trade, for example, is instance which commerce and products that are delivered via the internet, such as video, music apps, and ebooks, constitutes an important and growing share of the global economy and international trade. Current estimates indicate that a total value is $4.2 trillion worldwide. Yet, in spite of their growing importance, the issue is kept out of the Doha round. Within the mega-regionals, governments could negotiate extensive rules to govern this trade. Moreover, the growing importance of global value chains has provided multinational businesses with a strong incentive to pressure their governments to negotiate these deeper agreements in order to better protect their investments, to harmonize product standards across national markets, and to make it easier and cheaper to ship goods across national boundaries. The rapid growth of the RTA raises questions about whether they challenge or complement the WTO. WTO? This is not an easy question to answer. On the one hand, RTAs liberalize trade, a mission they share with the WTO. In this regard, RTAs complement the WTO, and on the other hand, RTAs institutionalize discrimination within world trade. In this regard, RTAs challenge the WTO. Economists conceptualize these competing consequences of RTAs as trade creation and trade diversion. Consider an RTA between France and Germany. Because the RTA eliminates tariffs on trade between France and Germany, more Franco-German trade takes place. This is trade creation. Because the RTA does not eliminate tariffs on trade between France and Germany on the one hand, and the U.S. on the other hand, some trade between the United States and Germany is replaced by trade between France and Germany. This is trade diversion. An RTA's net impact on trade is the difference between the trade it creates and the trade it deters. If more trade is created than diverted, the RTA has liberalized trade. If more trade is diverted than created, the RTA has pushed the world toward protectionism. Which of these effects predominates in existing RTAs? Nobody really knows, in large part because it's difficult to evaluate trade creation and trade diversion empirically. It is especially difficult once we begin to think about how RTAs evolved once created. An RTA that originally diverts more trade than it creates might over time create more trade than it diverts, or an RTA that could evolve in the opposite direction could do the opposite. Consider the first case. Some scholars have argued that RTAs exert a kind of gravitational force on countries that are not currently members. Countries that do not belong to the EU, but that engage in lots of trade with it, have a strong incentive to join. So it is no surprise, therefore, that over the last 40 years, the EU has expanded from 6 to 25 members. Some of these similar dynamics at work in the Western Hemisphere. Mexico's decision to seek a free trade agreement with the U.S. was at least partially motivated by concerns about the cost of being outside of U.S.-Canada free trade arrangement that had been negotiated in the late 80s. The interest of many Latin American countries in a free trade area of America is at least partially a consequence of Mexico's entry into NAFTA. Over time, this gravitational pull attracts so many additional members that a regional RTA evolves into a global free trade area. In this optimistic scenario, RTAs lead eventually to a global free trade in which trade creation outweighs trade diversion, and RTAs complement the WTO. By contrast, the creation of a larger RTA in one region could encourage the formation of a rival and more protectionist RTA in other regions. In this scenario, NAFTA as well as the FTAA could be seen as an American response to the EU. An emerging free trade area in Pacific Asia could be as a response to regionalism in Europe and the Western Hemispheres. In this view, world trade is becoming increasingly organized into 3 regional and rival trade blocks. Once regional trading blocks have formed, each block might raise tariffs to restrict trade with other regions. A tariff increase by one RTA could provoke retaliation by the others, leading to a rising spiral of protectionism that undermines global trade liberalization. In this case, trade diversion outweighs trade creation, and RTAs pose an obvious challenge to the WTO. Now, this is all I want to interject with. If you are one of those BRICS people and you are not thinking about BRICS throughout all of this, my brother, you should. And now, think about this. Where does the BRICS fit into this, especially if they're talking competition and gravitational pulls and trade diversion versus trade creation? Yes, I said we're going to link this to modern times, so tell me about the BRICS, baby. But moving on, it's impossible to predict which of these two scenarios is more likely. The world does not seem to be moving toward 3 RTAs, one in Europe, one in Western Hemisphere, and one in Asia. It seems to be moving. At the same time, governments appear to be aware of the challenges RTAs pose to the WTO, as they have created a WTO commitment on RTAs that is exploring the relationship between these arrangements and the multilateral system. Only time will tell, however, whether RTAs will develop into discriminatory trade blocs that engage in tariff wars, or instead, if they pave the way for global free trade. So, that is the chapter, that's that final part, but let's get the conclusion of the chapter. It'd be weird if we didn't, man. So here it is. Conclusion. The multilateral trade system is an international political system. It provides rules that regulate how governments, and remember, this is the summary of like the last 3 videos here. They regulate how governments can use policies to influence cross-border flows of goods and services. It provides a decision-making process through which governments revise existing rules and create new ones. And it provides a dispute settlement mechanism that allows governments to enforce common rules by promoting non-discriminatory international trade, by establishing a formal process for making and revisiting or revising rules, and by allowing governments to enforce those rules they create. The WTO reduces the impact of raw power on international trade relationships. In short, the RTO brings the rule of law to bear in international trade relations. Like all political systems, the WTO reflects the interest of the powerful. Its creation reflected the interest of a hegemonic United States. It's strengthened during the Cold War era, reflected by growing interests of European and Japanese governments that trade liberalization promised real gains. Although one can argue that the WTO reflects only the interest of the advanced industries or industrialized countries, the trends over the last 20 years suggest otherwise. The rapid growth in the number of countries joining the WTO during that period suggests that most of the world's governments believe that they are better off with the WTO than without it. That doesn't mean that the system is perfect. It does suggest, however, that in the contemporary global economy, the majority of the world's governments believe that they do better when world trade is organized by a system based on non-discrimination and market liberalism than they do in a discriminatory, protectionist, and rule-free environment. The WTO will weaken and perhaps even crumble when governments no longer believe that this is true. The largest contemporary challenges to the WTO emerge from the ability of its decision-making process to continue to produce outcomes in a changing world. On the other hand, the growth of WTO membership and the emergence of the G20 as a powerful bloc within the organization has raised the stakes of trade negotiations and has made it more difficult to find packages acceptable to the full membership. On the other hand, the emergence of a vocal NGO movement critical of the WTO's apparent tendency to place business interests before consumer interests has made it even more difficult to reach agreements within the organization. The full consequence of these two challenges remain uncertain. Can governments reform decision-making in a system in a way that simultaneously enhances its legitimacy and efficiency, or will continued decision-making paralysis impart additional impetus to regionalism? So hopefully you guys get it, man. We explore all this, we learn a lot, and then always by the end of it, we still don't have the answer. Yes, man, and things change. Starts out for the powerful, changes. Again, it's even talking about things crumbling, but Chad, I think I interjected a lot. I gave you a couple of things to study about. I hope you're ready for the next chapter, but now, that is your watch list, ladies and gentlemen. Make sure Hydra Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember that little voice you have. That's still the fact you still got a little voice telling you things. Oh my. Listen to it, baby. But Chad, I love you. Drink that water. Stay hydrated and healthy. I hope you enjoyed the weekend. Get refreshed. I'll see you in the morning. Shout out to the vets and